GrowFL webinar. This is a webinar series that GrowFL provides to our companies here in the state of Florida, our second stage businesses that we serve throughout the state of Florida. Our webinar series today is presented by Florida Capital Advisors, How to View Your Company Through the Eyes of Lenders and Private Equity Groups. So thank you so much for joining us. Just a reminder that you'll remain on mute throughout the entire webinar. We will be recording the webinar and providing you a copy of that recording as well as the slide deck for you to be able to review afterwards. In addition, if you have questions during the webinar, please provide those in the chat area and we will address those questions at the end of the webinar. My name is Tammy Sweet and I'm the director for GrowFL, and our mission is to provide strategies, resources, and support for second stage growth companies. These are companies that are between 10 and 99 employees, about $1 million to $50 million in revenue. And we work with them in a variety of ways, things like strategic research, which is where we help companies focus on top-line revenue and how to access new markets. In addition, we provide a variety of peer learning environments, including roundtables and forums throughout the state of Florida, as well as leadership development programs like the webinar that you're on today, as well as in-person events and other educational events. In addition, our program is also a partner of Florida Makes, which is the manufacturing entity for the state of Florida that serves the manufacturers here in the state. We are providing innovation and business growth services through the Florida Makes program. And we are excited to let you know that we have a new program that begins on May of this year, which will include strategic research, mastermind groups, strategies for success in areas such as human resources, operations, finance, etc. This is a program specifically for manufacturers here in the state, and we're excited to partner with Florida Makes on that program. If you'd like to learn more about our manufacturing-specific programs, you can visit growfl.com/Florida Makes. I'm happy to announce that nominations are open for our Florida Companies to Watch Awards. This is the 9th annual awards program, which will occur, which the nominations are open now. Applications will open in the middle of March, and our awards celebration will be at Hard Rock Live in Orlando on November 14th, 2019. So if you'd like to nominate yourself, or if you have companies in your community that you would like to nominate for this award, please visit the GrowFL website at growfl.com/nominate. We encourage you to check out all of our programs. I just provided you a snippet today of some of the things that we have going on, but definitely visit the GrowFL website at growfl.com and learn about all the various programs that we have going on here in the state of Florida. With that, I will turn it over to Chuck Alston, who is our partner here at GrowFL with Florida Capital Advisors, and he's got a great presentation today. I know we have a lot of interest in this program, so I am going to turn it over to Chuck. And just a reminder to everybody, you will remain on mute throughout the entire program, so you will not be able to actually talk during the presentation. So it'll seem like you're on the phone by yourself, but you're on the phone with many other people. There's a chat box in your webinar area where you can post your questions, and we will address those at the end. So with that, I will turn it over to Chuck Alston.
Thank you, Tammy, and good morning, everyone, and thank you for taking the time to join us on the webinar this morning. As Tammy mentioned, we will have time at the end for Q&A. The program is going to wrap up a little before 10 o'clock, so we can answer questions up until 10. I'm happy to address any questions that we don't resolve on the webinar today. My contact information will be at the end of the presentation. Feel free to reach out to me directly. So the title of today's webinar is How to View Your Company Through the Eyes of Lenders and Private Equity Groups. And the message here is we want to help you drive the valuation of your business, and when you're ready, whether it's a partial event or a full event, have a successful ownership transition. A little bit about me, 30 plus years, it's actually closer to 40 years, but I'm rounding down in both commercial banking and corporate finance experience. I joined Florida Capital in 2005 to help them raise capital and build markets out. took over as president of the bank division, which means I had the commercial banking area and other areas as it relates to the bank reporting to me. In 2015, I formed Florida Capital Advisors with the idea that a lot of the clients we've done business with over the years and a lot of new clients that have started companies within the last 5 to 10 years are beginning to think about how they ultimately monetize that company. And so that was the driving force behind putting together Florida Capital Advisors. A little bit about Florida Capital. Florida Capital Bank was founded in 2004. We have roughly $400 million in assets. That gives us the ability to lend roughly up to $5 million to any one borrower. We have full 4 service offices around the state in both Orlando, Tampa, Jacksonville, and Gainesville. We offer, like most banks, a full suite of commercial lending and deposit products. We're also a national SBA lender and a national residential mortgage lender. As I mentioned, Florida Capital Advisors was formed in 2015. We have 2 folks on staff that have credentials in both merger and acquisition advisory as well as exit planning. We spend our time primarily on advising and funding either a minority or majority shareholder buyout and real estate transactions. We also cover a universe of private equity groups by attending industry conferences regularly and meeting with the members of those private equity groups in our offices as they're looking for opportunities. We're one of the avenues, along with investment banking firms and other advisory firms, that these groups go to source opportunities for their funds. A little bit about our targeted transactions. As I mentioned, it's management, family, or employee buyouts. The typical company we deal with has an enterprise value of anywhere from $1 million to $10 million in valuation. That can mean anywhere from low 7-digit revenues up to $30, $40 million in revenues. That tends to be our strike zone or sweet spot from an earnings standpoint. $500,000 to $2 million, which is generally speaking the threshold below what private equity is interested in. In those types of transactions, those are typically financed through a bank or financed through the selling shareholder. And as I mentioned, we can do up to $5 million in loans, and the range is generally between $1 million and $5 million, both on a management or family buyout or on a real estate loan. And with respect to real estate loans, we can do both owner-occupied, meaning your company occupies the business real estate, or you may, as an owner of a business, decide to make an investment in real estate. We can fund those transactions as well. So let me just outline high level what we're going to get through today. And there's a lot to cover, and I'm going to go through this in pretty rapid fashion. As I mentioned, again, I encourage you all to reach out to me after the webinar if you want to go a little deeper in anything. So first thing I want to talk about is risk in a company and how that risk has an impact on the value of the company as well as transaction readiness. We'll talk a little bit very high level about valuation and value drivers in the business. We'll talk about debt versus private equity in a shareholder buyout transaction, whether it's a minority buyout or a majority buyout. We'll discuss both voluntary and involuntary ownership transition events and steps to take right after you get off the webinar, as well as over the next 1, 2, 3 years or potentially more, whatever your planning horizon happens to be. And then we'll take questions and reflect on key takeaways. So risk, and that's a theme that's going to be prevalent throughout this presentation today. And I've contrasted both how lenders view risk and private equity view risk in the context of a shareholder transaction. And what you'll note as we go through this is that there's some actual similarities between the way a bank looks at the risk profile of a company and private equity looks at the risk profile of a company, although private equity is going to go much more deep and be much more comprehensive in their approach to evaluating risk in a privately held company, because unlike a bank, they're either going to have the transaction work out like they plan it, a little better than they plan it, or not work out at all. Whereas in a bank, the bank's looking to get paid back. So the bank's going to not only look at the company's capabilities, but it's going to look at the collateral, if there is collateral as it relates to the transaction, and then the potential guarantees that may be in place as well. So as you can see from this slide, from both the lenders and private equity's perspective, excuse me, the senior management team and quality of that team are important, both from the lender's perspective as well as from the private equity perspective. High quality financial statements. We see a lot of companies that are doing $5, $10, $15 million in revenue and have very low quality types of financial statements. They're internally prepared. It takes them a long period of time to get issued. Here's one area, and we'll touch on this again in the presentation, where you can do yourself a favor from both the lender's perspective, or if you're going to sell externally, is really look at the quality of your financial statements. Financial performance is important. Consistent revenue and profit growth, or an explainable backup in that, if it's by virtue of an economic situation, that type of thing. From the lender's perspective, the legal side, if there are litigation pending against the company, that's going to be tough for a lender to get comfortable with. Environmental issues going to be difficult, and industry factors we're going to look at, like private equity. Is the industry in decline? Is it in disruption? Because if you have a company in an industry that does not have a bright future, that's going to affect not only repayment ability, but the investability of that company from a private equity perspective. Where private equity and lenders depart is where we get down to the collateral section here. We as lenders look at in a shareholder transaction, is there going to be any collateral that we can take? Oftentimes there's not, because the value of the business is largely dependent on the intangible value. If there is collateral, what's the advance rate look like on that collateral, and what's the loan to value based on that? And then lastly, guarantors. Do the individuals that are buying into the ownership of the company, is their credit strong from a liquidity standpoint? Do they have some personal balance sheet strength, and what's the personal balance sheet leverage profile? So just to summarize the last slide, the areas of a business that create risk from the lender and private equity perspective, again, a lot of overlap: poor quality financial statements, lack of profitability, customer concentrations, owner dependence. These are all things that are critical whether you're going to sell your company internally to management or family and look at a lender to finance that, or if you're going to sell it to private equity. The two biggest deal killers I hear from a private equity's perspective is that the owner's relevant to the too relevant to the business, there's no management bench strength, or there's too high of a concentration of customers. They'll see 30 to 50% of the revenue coming from one particular customer or group of customers. That's a high risk profile. So let's talk about how risk does get factored into what private equity is going to pay for a company and what value they see in that business. So this is more relevant, this slide here, to a private equity group as opposed to a lender. I mean, we're not necessarily looking at valuation. However, if we're going to finance the transaction, we've got to lend a percentage of the value. So value is important. However, as it relates to what private equity is going to pay, this slide here is really the slide we need to focus on. Everything above the company-specific risk premium here is called the equity build-up model. These are all, when a valuation expert goes in and values your business, these are basically pulled from publications where they come up with a minimum cost of equity. It's based on the risk-free rate, which is the long-term treasury rate, the equity risk premium for the large publicly traded stock market, and then the size premium as well. So smaller cap companies have more risk and therefore should have a higher return to the investor. So this is where the first part of this equation gets developed from. The company-specific risk premium is the area of the company that you as an owner have control over. And I'll show you how, on the next slide, how lowering the risk profile of your company can drive the valuation. So the company-specific risk premium, that premium that a buyer is going to put on the business based on the risk profile, can really have an impact on value. So this is right here we want to focus on as advisors and as well as owners of business. So a lot going on with this slide here, but the primary takeaway, this right here is a simple valuation formula where V is the value of the company, and in the numerator we're going to take the free cash flow of the company. In this particular example, we're assuming $1 million of adjusted earnings. K is the discount rate. So from the slide previously, this is what we arrived at in terms of the discount rate that ought to be applied to the company, and we back off that what the growth in earnings is. And in this particular example, we're going to assume 3%. So you can see where in this particular company with the same level of earnings, that as you move from a lower risk profile to a higher risk profile, that the valuation, again, same level of earnings, goes from $6.7 million to $4 million, or a multiple of 6.7 times down to a multiple of 4 times. So again, this is how risk impacts value in a company. Let's touch briefly on value worlds. I'm just going to address the first couple at the top. These are really the valuations that are based in the merger and acquisition world. These other valuations down here, fair market value, fair value, these are more in the litigation or estate planning world. The area we encourage a business owner to focus on is the intrinsic value of the company. The intrinsic, you may have heard Warren Buffett speak of the intrinsic value of a company, that he likes to buy a business below its intrinsic value. And what he means by that is, what is the risk-adjusted cash flow that I'm buying on a go-forward basis? If I can buy that company for less than that risk-adjusted cash flow, then I'm getting a good deal on that company. And this is the way, as a business owner, you should be looking at how to manage the value in your business. And what that is the cash flow of your business, adding back EBITDA adjustments like excess owner comp, excess salaries you may have in there for people that wouldn't be kept in a M&A transaction, coming up with that cash flow and discounting it by the appropriate discount rate. These values here, both strategic value and market value, are really dependent upon who the buyer of the business is. So your business at any given time can have multiple values based on who the buyer of that business is. Your value may have a higher value to one strategic buyer versus another because they see your business as either an avenue to sell their product to your customer list or sell your product to their customer list. So that's where you pick up the synergistic value, and therefore why a strategic buyer can pay a higher value to you than necessarily a financial buyer can. The market value is the value of your business once the transaction is complete, once you run a process, and you'll realize then what the market value of your business is. Value drivers. We touched on some of this earlier in the presentation when we talked about what causes risk in the business. So I broke these down into primary and secondary drivers of value in a business. Obviously, in any situation, lending situation or private equity situation, positive revenue EBITDA and trends are important. If there's choppiness in earnings, for whatever reason, that's a little more difficult story to tell, both to a lender as well as to a private equity group. Again, owner dependence critical, especially if a private equity group is buying you and you intend to leave. Then if the business goes with you, not a lot of value in the business. Strong management and sales team. Very important to develop managers, make sure that there's some continuity if something were to happen to you. Build some bench strength, both in the management team as well as the sales team. You're going to see a higher valuation relative to your peers if your margins are better than industry comps, and that's a sustainable situation. We touched multiple times on the fact that it's important to have diversification in your customer base, but also to the extent that a portion or all of your revenue is locked down either contractually or some type of subscription model, that has a tremendous amount of value as well. I'm not going to go through the rest of these. We can talk about these offline if there's anything in particular here that you all have a question about, or we can address in the Q&A section of the presentation. So let's talk about the options on a buyout, both from a debt standpoint and a private equity standpoint. So working from the left side of the slide first, where there's two options in both cases. There's either 100% change in control, you're done, you're ready to leave the business, you want to sell it, or it could be a two-step process where you sell a minority or majority interest. And again, both these options are there for you either in a debt situation or a private equity situation. I'll say that on a private equity side, there's going to be a debt component to that, meaning that the private equity group is going to go out and borrow money in addition to putting in their equity capital to complete the transaction, whereas in a debt situation, the buying shareholders are going to need to go out and find a bank or some type of finance company to finance the transaction. So on the debt side, with respect to 100% change of control, you're either selling the company to management, family, or minority shareholders, or some type of outside buyer that's going to require to get financing. Typically, you as the selling shareholder are going to need to finance some of that transaction, or depending on the risk profile of the business, you may wind up needing to sell or hold a substantial amount of financing because a lender is going to perceive that transaction to be too risky based on some of the risk points that we touched on earlier. Or you may decide that you want to stay involved in the business more, but you use some of the proceeds from the sale to either diversify your net worth or give loyal employees or management the ability to begin to enjoy equity participation. In that case, you'd sell a minority interest, probably not a majority interest. And again, this could be to insiders, or there may be somebody that you want to join the company and potentially be your successor down the road. You give them the opportunity to buy that minority interest. They're going to need to go out, and get that financed. And you may, as the owner of that business, depending on the financial strength of that buyer, need to guarantee that bank loan. So let's contrast that with private equity. So there are a lot of private equity groups out there, hundreds, that will come in and back family, management, or other minority shareholders to buy the business. Or your company could be a platform for a private equity group to go out and roll up similar companies in your business, or you may be an add-on transaction, depending on the size of your company, for a private equity group that already has a company similar to yours in their portfolio. In that case, they may be acting more like a strategic buyer, meaning that there could be some synergies that they could realize that you could extract more value for your business because you'll participate in some of those synergies. In that particular transaction, 100% change of control, unlike the debt scenario, you will not be required to provide financing for that transaction. However, you will have some contingency payments or holdbacks in a situation where a group's buying 100% of your business. With respect to the minority and majority side of things, most private equity groups were doing majority recapitalizations, which is somewhere between 60 and 80% ownership, and the selling owner would roll over at that valuation for anywhere from 20 to 40%. more and more private equity groups now are considering doing minority transactions. Again, you have to have a high-quality company for either case, but especially in the case of a minority transaction. And these types of transactions, you as the owner are going to continue to stay involved in the business more than likely for the next 5 to 7 years. At that point, most private equity groups are looking to exit the business, which hopefully syncs up with when you, the owner, wants to exit the business ultimately as well. These types of transactions are good for providing diversification for you as an owner. Typically, we see most business owners have a substantial portion of their net worth wrapped up inside the business, so it's a good individual diversification move. Money's there for growth capital, so you may be capital constrained to take advantage of new markets. There's an opportunity to bring in some fresh capital and to be opportunistic about that. And there's a chance for another liquidity event down the road, whether it's 3 years, 5 years, or 7 years down the road. And at this point, you as a selling shareholder, if you're already on bank loans, those will get refinanced as part of the transaction, and you will no longer be required to do any guarantee of those loans. So again, a good risk diversification move for you as a business owner. A few more points on the contrasting debt and private equity. So the biggest distinction probably is what the cost of capital would be for a shareholder transaction when a bank or some type of financial entity is going to finance the transaction versus private equity. Typically, these type of transactions get priced off of prime or LIBOR. The spreads there can range, from 250 basis points over LIBOR to 600 or more. Prime, it could be prime flat to 300 or 300 basis points over prime, which is prime plus 3%. That's all going to be driven off the risk profile of the company. It's going to be driven off the risk profile of the guarantors and the collateral that's there. If there's, whether it's a personal guarantee or an SBA guarantee, that's also going to drive what the pricing looks like. But still a much lower cost of capital versus private equity, where private equity is raising capital from their limited partners, and they're pitching those limited partners somewhere between a 15 or 25% return, in some cases more than that. So that capital is going to be much more expensive than it would be from a bank standpoint. If you do a situation with debt, unlikely that there's going to be a lot of influence over management by the lender, although in the private equity world there is going to be some influence and involvement in management, and probably going to require some type of board presence, and also going to be active in corporate governance as well. You as the, if you do a transaction with debt, you have some control over exit timing. So if that 5 to 7 year window doesn't fit you and you want to do it sooner or later, you have control over that. Whereas with a private equity transaction, you're not going to necessarily be able to control when you exit that company. Going to be covenants and collateral requirements typically in a debt transaction. That's not going to be present in a private equity situation, as we already discussed. So how do you get the best terms and price? A lot of repeat of what we talked about before. It's from a lender's perspective, it's good financial performance documented by high quality reports, good diversification in the customer base, strong management team, and high quality collateral and guarantor support. And the last point there is, many of you all probably have a primary banking relationship in place right now. Consider having a secondary banking relationship. We as Florida Capital Bank have primary banking relationships with clients, but we also have a fair amount of secondary banking relationships too. It's nice to have a little bit of competitive environment there with another lending partner. From a private equity perspective here, unlike the lender's side of things, having avenues for growth. Private equity, when they buy your company, is looking for ways to grow your cash flow. Are there new geographies that you could go into? Is there a complementary product opportunity? In other words, do you have something now that with some slight modification could create another product and a new opportunity for growth? Private equity is looking for companies that have a competitive advantage. There's high barriers to entry in your industry. You have pricing power, which generally means that you have a strong brand or some type of patent or proprietary aspect to your product. That gives you, as a company, a competitive advantage versus another company in your industry. So I want to touch, before we get into what we do over the next several years, into potential trigger events. And most of what we talk about here today is all a voluntary trigger event. You may decide to sell some portion or all of your company, and that's voluntary. You may want to diversify your net worth, or you may have your family or key management that's seeking to buy into the business. A lot of private equity groups right now are approaching businesses directly. I'm seeing some businesses having conversation with those private equity groups without an advisor present. Not a great idea. I mean, their goal is to become your friend, build trust, and get the best possible deal. And if you don't have somebody representing you beyond an attorney or beyond a CPA that has some experience with negotiating deal points, then you're working at a disadvantage. Involuntary events. As we all get older, these are things that we begin to think about. We're a little less bulletproof than when we're younger. So health, somebody may, at some point in the future, have a bout with a health issue. Divorce, disputes, death, these are all things that while you're running your business, most entrepreneurs don't think any of this is going to happen to them. But plan for the worst and hope for the best. And when there's some type of trigger event that happens, you and your company are going to be in a great position to capitalize on getting the best price for the business. So what steps should you take once we get off the webinar or sometime in the next 30 days? Well, first I would encourage you to build an advisory team. And this would include not only your attorney and CPA, but your wealth manager. If you don't have one, you should find one. Advisors like what we do, investment banking advisors, depending on the complexity of your business and ultimately what you're trying to achieve, begin to assimilate an advisory team. Work with a wealth manager to develop a personal financial and estate plan. If you're planning to sell your company 3, 5, 7 years down the road, understand what the value of that company is and work with your advisor to understand on an after-tax basis, am I going to be able to retire with the proceeds of that and other investments I have? And the answer, unfortunately, a lot of people are coming up with, I'm not going to be able to. So, understanding what you need now and working towards that goal over the next 5 years is critical. I mentioned earlier in the presentation that reviewing your accounting practices and improve your quality of your financial statements. That's a relatively simple, relatively low-cost fix that'll come back to you with a multiplier effect down the road. If you don't have an organizational chart in place now, get one in place. A lot of small companies don't feel like they need one, but a simple thing to put in place. Document your important processes. A lot of small companies, those processes are rattling around in the minds of the owners or key management. Important to document those processes so that someone else can step in at a moment's notice and continue to operate the business. If you have real estate in the business right now, which a lot of companies do, generally speaking, in some type of ownership transition transaction, that real estate's not going to get bought. It may get leased if the real estate is really relevant to operating the business, or it may not. But get that real estate out of the business. If you've got financing coming due, whether the property, the real estate is owned in the business or out of the business, take advantage of the long-term fixed rates that are out there now. We're still in a very low interest rate environment. and taking advantage of locking that down for a long term, up to 10 years, we're at a good time to do that. Our bank, very aggressive right now with financing real estate transactions on a long-term fixed rate basis. So if that's of interest of you, anybody on the call, please feel free to reach out to me on that. Steps to take over the next year, and as we go through these, the next year, 2 years, 3 years, some of this could slide around, but I try to put it in some type of orderly fashion that, you know, we can take bites at this on an annual basis and none of this becomes overwhelming. So establish an advisory board or board of directors. Most small companies don't have fiduciary boards of directors. So with that said, consider putting together an advisory board. Bring in your accountant, your CPA, your banker, another business owner in a non-competitive industry, people that you value their opinion. Meet with them regularly, give them a look into the business, learn from their mistakes and experience, meet on a regular basis, pay them for their effort, but do that. It'll come back to you in a big way down the road. Complete a formal risk assessment on the business. Going back to the things we talked about, what creates risk in the business, jot those down and do an honest review of your business and assess what the risk looks like. If you want to do it in a more complete and detailed way, that's something we do with business owners. We'll go in and do a formal assessment of the business with all the areas that we discussed on the previous slides, and we'll come up with a intrinsic valuation calculation for the business as well based on that risk profile. Make sure if you have intellectual property that is protected, and essentially intellectual property doesn't necessarily mean a patent. It does, but it could mean a lot of other types of things. It could be your handwritten process manual. It can be your employee handbook. All those types of things you need to protect. Make sure your contracts are up to date with customers and vendors. A lot of small companies don't have employment contracts. You may want to rethink that, especially with key management or key employees that are carrying confidential information around in their mind. Make sure that there's an agreement in place that protects you from them sharing that information with other potential employers, and work on improving your hiring practices. I think we've all experienced the expense from a money standpoint and time standpoint with hiring the wrong employees. Steps to take over the next couple of years, you may want to consider who your successor is going to be. If you have them in the company, begin to develop them. If you don't, you need to find them, get them integrated in the company, and give them an opportunity to really understand the company holistically. This is now an opportunity to begin filling in holes in the organizational chart, making key hires. Develop a comp plan for retention of key management employees. Make sure that plan ties in with your overall strategic plan. Make sure that plan rewards the behaviors that you want, and more importantly than anything, drives improved revenue and improved profitability of the business. Here's when you want to determine you may want to make some investments in the business, whether it be with new plant and equipment or maybe it's a new sales team. Before you start making investments in the business, you want to make sure over the previous year that you've taken steps to reduce the risk profile. Making investments in the business for growth or accelerating growth with an acquisition strategy or putting a new sales team in a new market could create more risk in the business than it could increase value, because there's too much risk present in the business. So start with that assessment. Fix things that need to be fixed before you make monetary investments, people investments, and capital investments in the business. Over the next 3 years, this is when you want to consider getting your financial statements audited. Every private equity group I've talked to, that's an important thing for them to have, is a high degree of faith in the validity of the numbers. And if you get your financial statements audited, whatever that cost is, in most transactions, you'll get 5 to 10 times that cost back in the value of the business. Get a quality of earnings report, which is a different document than what the audit financial statements are. Private equity groups get quality of earnings reports. You want to get one too, so that when you're negotiating various nuances in EBITDA or other aspects of the business, you've got a quality earnings report as well that you've paid for. It's no different than selling your house and you getting a inspection of your house because the buyer is, and you can defend that buyer's inspection because you have one too, and you're coming in from an informed approach. This was a good time to start accumulating and putting in a centralized, preferably electronic data room, due diligence information that a buyer is going to need, which is going to include all your financial statements, your policy procedures manuals, organizational charts, and numerous other things. Continue to work on improving your systems and processes. To the extent you can automate, do it. And this is not anything I touched on, but if you develop a culture of innovation in your company culture is really important to private equity groups because that culture drives the business. And if there's a culture of innovation there, meaning that there's always a process for continued improvement, a process for continuing to expand product lines, that type of thing, that's a culture that adds a lot of value, and that'll be reflected in a sales price when you go to sell. So I'm going to conclude with these last couple of slides. When you look at yourself in the mirror, here are the questions you need to be asking yourself. Would the business survive without me? If it doesn't, you need to get that fixed. That's a problem. What do I need to do to retain my key management and salespeople? If you're not doing anything now, you need to begin to think about what that is and what that looks like and get that implemented. Are you running your business to maximize value? A lot of business owners, especially with small companies, are running their business to maximize income for the owner's distributions, but it may not be maximizing the value of the business. Are there risks in my business that I can address to lower either borrowing costs or improve my value? Gets back to the risk assessment. The deeper you can go, the more honest you can be with yourself about the risk profile of your business and get that fixed. It's going to come back to you. And then the last one is, would I buy my business for the price I expect to sell it? Biggest disconnect is buyer's expectations and seller expectations of value. So look at it from the buyer's perspective. If you want $5 million for your business, would you buy your business for $5 million? If the answer is no, then the reality is you're not going to be able to sell your business for $5 million. Couple of takeaways: don't go it alone. Definitely utilize advisors. Have an advisory team. Have a board of advisors. Don't underestimate the value of collective groupthink. Understand the risk of your business and implement the de-risking initiative sooner rather than later. If you don't have a business valuation, you don't need a formal valuation that's a certified valuation, but getting a valuation based on discounted cash flow with the risk profile that we discussed and updating that every couple of years to see the progress you're making is a great way to track your success in running the business. Manage the intrinsic value. Again, that's the value that you have control over. You don't have control over the other valuations that we outlined earlier. Run your company as if a trigger event may happen at any time. You have control over the voluntary events. You don't have control over the involuntary events. And last but not least, always plan for contingencies. I'm going to stop there and open it up for questions. I can see there's quite a few in the question bar. Tammy, I'll turn it back over to you, and I'll leave my contact information up here. Again, I encourage you all, if you have questions or want to talk something out offline, please feel free to reach out to me.
Great. Thank you so much, Chuck. We do have a couple of questions in here. I know Rick Hunter has a multi-part question. His question here focuses on the assets that he has. He has a $2 million building, $1 million in equipment, and that never seems to be reflected in the sale compared to maybe a web design company with 0 assets and could be worth a lot more than that. So how do you adjust the disparity?
Yeah, so what a buyer is buying, let's talk about a whole company transaction, 100% change control. They are buying a debt-free, cash-free business. So if there's excess cash, that's an asset the seller is going to keep. If there are excess assets like a building that's not relevant to the business, that's an asset that the owner is going to keep. Or the owner can keep the asset and lease that building back to the buyer of the business. So in asset-heavy companies, what the buyer is going to be looking for, and most of the time these transactions are structured as asset purchases as opposed to stock purchases, and I won't go into a lot of detail around that, other than say again, most of these deals are structured as asset purchases. So the buyer is buying the assets that are relevant to generating the income stream that they're buying. So if that piece of equipment is relevant to generating the income stream, then that goes with the asset purchase and part of the sales price. If there's equipment that's not relevant to the cash flow stream that the buyer is buying, then that owner may be able to keep that equipment. Same thing with excess inventory, that type of thing. The seller needs to deliver adequate working capital to continue to operate the business the day that the keys get handed over, but excess assets, like I just described, would be assets that typically the seller would get to keep.
Another part of Rick's question is regards to the M&A companies that are looking at the gross sales of the company, and the gross sales that he has are half of what they are looking for, but the net profit is 5 to 6 times the competitors. So how does that get shored up?
Let me repeat back what I think the question is. So there are customers of the company that are very high margin companies and therefore higher value in the mind
right.
of the seller versus some of the other types of customers, right?
Right.
That's the question. Yeah, I think again that if the things that are going to come back to the seller of a business is if there are margins that are in excess of the industry competitors for the same type of product or service, that seller is going to receive a premium. If there's aspects to that revenue stream, it's locked up for an extended period of time. It's subject to contracts that are not easily cancelable. It's a subscription model that's not easily cancelable. Then that's going to be reflected in a higher price, a higher multiple that buyer would pay for that revenue stream.
A question from Albert is directed to you, Chuck, are most of your transactions in the form of ESOPs?
In fact, very little of our transactions are in the form of ESOPs. You could do a whole webinar on ESOPs. Most of the transactions we do from a lender standpoint, the only similarity is that you're using the cash flow of the business in order for someone to do a shareholder buyout transaction, and it can be done either in a minority fashion or a majority fashion. In an ESOP, I believe it's either 30 or 40% of the company has to be sold to the ESOP in the first tranche in order for the selling shareholder to get the tax benefit of the stepped-up basis and defer the tax on that. That would be one reason to do an ESOP, is for the tax benefits of it, but that has to be offset against the costs of an ESOP, like annual valuations. You're now a planned fiduciary, and so you as an owner that's selling to the ESOP has fiduciary liability. There's administrative costs that go with that type of thing. So we don't, as a bank, do ESOP transactions, not our specialty.
Question from Nan as far as going through the VC or PE route, and she says that the fact that they may be open to taking closer to 30% is encouraging. What would drive the lower percentage requirement?
Yeah, so first, a distinction between venture capital and private equity. Venture capital generally more early stage. There may not be positive earnings yet, that type of thing, versus private equity is generally going to be steady state companies, predictable earnings, that type of thing. So as it relates to private equity buying something less than control, which could be 60% or more, so something down in the 30 to 40% range, is going to be driven off a couple things. One is the type of industry that particular company is in, right? So if it's an industry that has great long-term prospects, that could be healthcare or certain areas of business services or certain areas of software as a service, that type of thing, that's where you'll see minority investments. If there's a high recurring revenue component to the business, you'll see minority investments there. There are strong margins in that business, you'll see minority investments there. It'll be a minority interest from an equity standpoint, but again, they're going to protect their interests with governance documents, some type of board seats, that type of thing that gives some balance to their minority equity position.
A question from Sam is, how does inventory affect value? EBITDA does not adjust for $500,000 of inventory debt-free.
Well, as I mentioned on the last question, that when you sell your business, you're selling as an asset sale. If you've got inventory that's stale inventory, that's not contributing to the cash flows of the business, I would segment those out, and to the extent it has any residual value, you may be able to just keep that or sell it in a separate transaction to a competitor or someone else. But you're going to have to deliver a level of inventory, which is part of working capital, in order that day the new buyer, new owner takes over, that they've got inventory there to continue to sustain that cash flow. Now they're going to continue to have to buy new inventory as that inventory sells and so forth. But it's going to be different from company to company. It's going to be addressed in the minimum working capital requirement, and then if there's inventory that's not germane to the business going forward, that may be an asset that the owner can keep.
Question from Marcelo in the education sector. What metrics would you use for early stage companies with a proof of concept and some revenues, development plans signed to 20-fold the business? A DCF would not be viable at this stage, as I see any multiples suggested.
That's correct. I mean, we do not operate in the kind of the pre-revenue, pre-profitability range. So, I mean, you really would need to find some type of early stage investor, whether it's angel investors or some type of venture fund that has experience in that particular space. They'd be able to tell you what the key metrics are. I would not, outside my area of expertise.
Thank you so much, Chuck. If you have an additional question, go ahead and type it in quickly. Other than that, I will leave it to Chuck for some final words for the group.
Nothing else. Again, thank you for taking time. I hope we rushed through some of this. So to the extent that any of you want to talk about anything offline, again, I would encourage you, if you didn't have a chance yet, jot down my contact information, my email address, give me a call, send me an email, and happy to chat about it later.
Great. Thank you so much, Chuck. We did record this presentation, and we'll be sending that out along with Chuck's contact information to you in an email here later this morning. And if you have any questions, please let us know. Again, we encourage you to check out GrowFL's programs. In addition to the webinar today, we will be having a webinar on March 13th that will dive additionally into the valuation of your company. So we encourage you to check that one out as well. So thank you again for joining us today. Chuck Alston from Florida Capital Advisors, thank you for your support and a great presentation today, and we will see you all on March 13th. Thank you.
Great. Thanks, Tim.